I'm Jay Bryson, the Chief Economist of the Corporate and Investment Bank at Wells Fargo, and I'm joined today by my colleague, economist Shannon Seery. So Shannon, it looks like we've made some downgrades to our growth outlook here in the second half of the year, particularly as it relates to consumer spending. What's going on?
Right, Jay. So a lot of the downward revision over the past month has to actually do with the latest outbreak of COVID, right? So the Delta variant is on the rise here in the United States, and new daily case counts are averaging about 150,000 per day, as hospitalizations have also picked up. So while we haven't seen, government mandated restrictions, and we don't expect to see those, consumers have voluntarily pulled back on activity. So if we look at high frequency measures of activity, there has been a pullback in, dining out and air travel, as well as a slump in confidence measures for the month of August. So if we square these readings on August with what we saw in July, where real spending contracted by about a tenth, the third quarter is really shaping up for a much weaker consumer spending profile than we were previously anticipating. So we're now forecasting real consumer spending to advance about 1% at an annualized rate in the third quarter, compared to about 7% that we were previously forecasting in our last update. So I think it's also really important in terms of the discussion for the consumer, Jay, to highlight, we still expect consumers have the means to consume. It's just this renewed virus fear, I think, is weighing on some of the near-term activity. But eventually consumers should be able to, pick up their spending habits again once the virus hopefully subsides. So on that note, Jay, how have our expectations evolved next year and even into 2023?
Right. So, this is the first month that we're forecasting 2023. And, I'll just get to that in just a second. But in general, what we're looking for is this expansion to remain intact. And it's based on the assumption that sooner or later, the Delta variant will become less disruptive. I mean, sooner or later, most people will be vaccinated or they will have contracted the virus and will be approaching some semblance of herd immunity, and the economy will more or less go back to normal. Now, we don't presume to know exactly when that's going to be. I mean, we're kind of penciling it in early part of next year. And so we do have some stronger growth in the earlier part of next year. When you look at our overall forecast for 2022, we're looking at 4.5% real GDP growth. And as we go forward into 2023, we think we're going to be growing at 3%. So it's a little bit of a slowdown, but it's still above trend growth. And generally, the underlying fundamentals of the economy remain solid. If you look at balance sheets among consumers and balance sheets among businesses, they all remain solid. Policy settings are very accommodative at this point. So we believe that this expansion will continue. So Shannon, let me ask you this. Right now the Fed is buying $80 billion worth of Treasury securities every month and $40 billion of mortgage-backed securities. Do we see the Fed, taking away that sort of stimulus anytime soon?
Right, Jay. So the Fed has really been looking for substantial further progress in terms of their labor market mandate, right? So we have seen some progress in the labor market. The unemployment rate has fallen pretty significantly. It's just above 5% through August. And despite that weaker than expected August job gain that we received recently, there's about 10 million job openings in the economy. So there's still this rapid demand for labor, even if supply is struggling to meet that demand. But as we look forward, we expect the labor market to continue to improve, going forward through year end. And by the end of the year, we do expect the Fed to deem it appropriate to start to remove some accommodation. So specifically, we're looking for the Fed to officially announce tapering at either its November or December policy meeting and kick it off either late this year or at the early part of next year, right? So they'll start to taper those asset purchases that previously mentioned. And that will result in some upward pressure on yields in the next few quarters. Now, Jay, as we're talking about the Fed, perhaps taking its foot off the accelerator here in the near term with tapering of purchases, do you also think that rate hikes could be around the corner?
So, in a word, no, not anytime soon. You talked about the labor market earlier, and in order to hike rates, what the Fed wants to see is us at quote maximum employment. Now, none of us really know what maximum employment really means, but you mentioned the unemployment rate right now is at 5.2%. That's probably not maximum employment. And even at the end of next year, we think it's going to be roughly 4% or so. But keep in mind, at the end of the last cycle, we got the unemployment rate down to 3.5%. So, in the near term, we think the Fed is going to remain on hold. We actually think that's probably going to the Fed will remain on hold through all of next year as well. Now, in 2023, it's a different sort of story. We think at that point, the Fed will be saying, okay, we're approaching maximum employment. It's time to start raising rates. And what we have penciled in is 75 basis points of rate hikes, generally in the second half of 2023. But I'd be the first to acknowledge, that's 2 years out from now. That's a long time away. So I think the point here is, even though the Fed may start to taper later this year, we don't see them raising rates through next year. But obviously, this is an evolving story, and we'll be keeping an eye on it. And as we continue to evolve in our thoughts, we will continue to keep you updated with these videos. Thank you very much for joining us today.